All right, we are live. What is happening, everyone? Welcome back to another episode of the Deep End. I believe this is number 27, if I'm counting correctly, and we are coming to you live over on YouTube. How's everyone doing today? Ari, how are you, man?
I'm doing fantastic. As always, we're powered up by Blossom, which, by the way, I was just looking through Blossom and the community notes and seeing where your portfolio is at, if you just made any big changes. And I was going to make a post, which I'll make after our chat here. But man, you want to know what's killing me this week? I have more than enough to cross my finish line of $300,000 in the brokerage account. But I got to put some aside. I still got to finish up my taxes. So I got to put some aside. That's well over 12,000 right there. And then I got my big loser, United Health, as we all know, and Visa. Visa, I'm actually green in, but I'd like it to be, a little higher than where it is now. Either way, I'm doing great. No complaints aside from taxes and having to pay Uncle Sam. It's not a bad thing to pay Uncle Sam. But how are you, Ryan?
Good, man. I can't complain. Right now, I'm looking at an all-time high in the portfolio. Right now, we're sitting at 102,204. So we're up just a little bit more week over week. It's crazy. I'm looking at the gain. I'm only up, 0.84%. But now at this stage in the game, that's $864. So even in just like the short amount of time that I've, been over the six-figure mark in the portfolio, I've already seen how the gains, the percent changes are going to move the needle more than when the portfolio was at a smaller account value. And I think going back to, Charlie Munger was the one who said $100,000 is the number. You've got to get to at least $100,000. And I know, guys, he said it 20, 30 years ago, however long it was. Inflation exists, stuff like that. But still, using this six figure as the benchmark, I'm starting to see now, just in this short amount of time, why it's so important to get to this number, because I'm already seeing like the needle move even more. It's just been a few days, and we're already up we're already 2.2% of the way to the next 100K. And so yeah, it's pretty cool. I can't complain, man. That's what I'm trying to say here. Can't complain.
How does it feel that you're keeping your head above 100,000?
I'm gonna knock on wood right there. Hopefully it stays that way, but it feels good. Yeah, it feels good. I'm actually kind of surprised. I thought it would have dipped back down below 100,000 at least once, but so far hasn't happened. It's actually been, pretty good week in the market. And I've been so busy, man. Maybe you can enlighten me, or you guys here in the live chat can enlighten me. I've been so busy this week. I really haven't been paying much attention to the market, so I don't know. I don't know exactly what's been causing these gains. Do you have any insight in that department? Do you know what's going on?
So at a very granular, level, one of the things I actually thought that was going to bite us was, Trump started to tout tariff rules again, if you will, right? And I was waiting for any tariff news to then sweep the headlines and spook the market again, which it did very ever so slightly. But all in all, I really do. I think we're moving in the right direction. And, inflation is, basically on par from where our expectations have been, which is great. The consumer is well armed. I just saw earlier today that Delta reported strong earnings and that revenue was up. Consumers, at least in the Delta Airlines front, were ready to spend. So that's a good sign. I like to use earnings season, depending on the company, to understand where the consumer's at, because they're ultimately going to tell us where we're going to go. And just good to see that consumers are flying, they're taking their vacations or going wherever they're going without any limitations. I think we're going to have a pretty good earnings season, to be honest with you. And I think we're actually going to end this year very strong. And I think that's generally what the consumer feels. And that's why I think, based on everything. And by the way, geopolitically speaking, even that's a big deal. There's no real, new news, if you will, nothing too devastating that would have rocked the market. So I just think we're at this ascent, are on pace to continue to be on an ascent. And I'm all for it. To watch my portfolio go up. I'm a little bittersweet though, because I like to buy on red days. And I did buy earlier today some more of my tech ETF, which I've been doing now pretty adamantly. I think it's at 32 or 33% of the portfolio now.
Wow.
And from this point moving forward, I think everybody who's watching my portfolio, again, all on Blossom, likewise with Ryan's portfolio, you're going to see that I'm going to just be eating this tech ETF up all year long and the remainder of this year, because I just look at this. I don't know if you caught this news the other day, Ryan. It's big. Nvidia just hit $4 trillion of a market cap. That's
Yeah, I did see
insane.
that. I did see that.
And
What do
just
you
based on what that means for us, like the future, I keep saying it, the future's tech. I think that's an obvious statement, but that means that any investor out there that's not 60 and not really concerned about having, money in their retirement account, I think should be a little bit more gung-ho on those growth stocks.
So you think, is this to say then that if someone has a long time horizon, they could look at I guess what I'm trying to ask is for that person, is Nvidia still fair play? I mean, it's run up so much already. Is it still, is it still a good buy despite how much it has already climbed?
I think so. And the reason I say that is because we're in like and I was at the dog park a couple hours ago, and we were talking tech and the future of tech, and I said to this gentleman, we are still really in like the baby booming era here of tech and quantum computing and AI, and these chips. And so I think we have to understand where we're at, which is just the very beginning. And once you realize that we're at the beginning here of this new tech boom, I think, it's fair game. It's fair. All of these Mag 7 players that are now developing their own chips, and angled on AI and quantum computing, I just say get ready. I mean, the bull is still going to run here for these tech stocks.
Yeah. And real quick, just as a sidebar, I see some chatter here over in the live chat. You guys drop all of your investing questions here in the live chat. As you guys are submitting them, I'm saving them so we can go through them here pretty soon. But yeah, one note from Ron here. I'll put it up on the screen. Ron says, what about Broadcom? Broadcom has been great. Dividend rate is fine. Also happy with SOXL, which is a semiconductor ETF, I believe. Do you think that's a good way to go? I mean, at this point, it's how do you choose between a company like an NVIDIA or AMD or Broadcom or TSM or Texas Instruments? I mean, and keep going with these names. I mean, even companies like Apple and Alphabet are kind of semiconductor companies, sort of, because they do design their own chips now. Maybe Alphabet. No, I don't think they make them. I think they're just maybe designing them.
The chip? They
Yeah,
did come out with one of their own chips.
Yeah. What I mean, do you think something like SOXL is a good way to go? Just blanket. Don't even pick them. Just buy them all. What do you think about that?
Yeah, I kind of look at this through the framework of, just if you're looking at, let's say, Visa, MasterCard, and American Express, which one out of the bunch do you pick? And I think that this question in and of itself is actually a really good question. When you're looking at a certain sector and there's like the top 3 big dogs, which one do you pick? And I actually always will look at a couple of different factors. First and foremost, I want the healthiest balance sheet amongst all of the companies that are in the running, because the financials are there. That just makes me more comfortable. But I think it's also worth noting that if you're the head honcho, you'll actually make more money with, say, player number 2 or 3, in my opinion, or there's the potential to do that, versus everybody gunning for, in this case, an NVIDIA. And so I don't think going with a Broadcom is a bad option. I don't think going with any of these other chip players is a bad option. I do think a very safe and reliable bet is just to kind of Pokemon it and catch them all, because of the fact you can't lose. And that's why I'm a big fan of even, how I'm currently heavily doubling down on tech is not just trying to pick some of the best. Although I have, Apple, Alphabet, Amazon in my portfolio as individual plays, really I'm hunkered down in this tech ETF because it's not my forte to really look at these tech stocks. So I'd rather just grab them all. And I think, therefore, grabbing all the chip stocks is also a great way to go. It's just safer.
Yeah, that
What do
makes
you
sense,
think?
man. Yeah, I would agree. If I was to dip my toe in that pond, I probably would go that route. And that's a lesson that I personally had to learn the hard way with Intel. After owning Intel, I realized, fortunately, I made a little bit of money on it, but after owning it, I realized this is just not my wheelhouse. This is not my, I don't know if I have an area of expertise necessarily, but if I were to have one, it would not be in the semiconductor space. So I would look to probably cast a wider net and just, you know, kind of put my Ash Ketchum hat on and try and catch them all. Not a Pokemon guy, but that was a Pokemon reference for you guys. But dude, you touched on something interesting a moment ago, and this is a question that I feel like I get pretty frequently. I would imagine you do as well. But you touched on like a Visa and a MasterCard and Amex. Other instances of this could be like Home Depot and Lowe's. I get this question all the time where people will ask, is it okay to own, because those types of companies are so similar, Home Depot and Lowe's are so similar. Visa, MasterCard, identical. Amex is in there too. It's a little bit different, but when it comes to those companies that are so similar, how should you approach that? Because a lot of people, there's some people who like to own both of them, casting a wide net. There's other people who think just because they're so similar, just pick one, pick which one you think is the best. No need to own both because they're, nearly identical. And we can come up with some other examples of similar companies like that. But when it comes to like the Home Depots or Lowe's or the Visas and MasterCards, what do you make of that? Do you own, is there room to own both? Do you just pick one? What camp do you fall into?
I don't think anybody should own both. I think if that's the way that you're investing, you might as well just go with an ETF,
I
or an
agree.
index, or, the alike. Because my take is, in order to be an investor, you got to pick stocks. And you then want to make sure that your portfolio is diversified. It doesn't matter if it's 5 stocks in your portfolio. A portfolio with 5 stocks can still be diversified. Are you across sectors? That's important to understand. But the moment you start to now, take the Home Depots and the Lowe's, and I'll throw in, Stanley Black & Decker in there, and you just start, now you're getting sector specific here. And so you might as well just go with the ETF or the index. Now, when it comes to approaching the pick, if you will, the draft pick for the portfolio, I really think maybe first and foremost, it should come down to personal preference. In my thought process, I invest into things that I actually buy and consume, or that I use. And if I'm not buying and using it, and I'm just investing into it because it's a moneymaker, well, I want to have a second look at that and really test my why, my thesis on it. Is it because everyone else is investing into it, or is it because I actually believe in it? And if I actually believe in it, I probably then will be using it. And so with the Home Depot versus Lowe's, or the, Visa versus MasterCard, I don't have any MasterCard, MasterCards in my wallet. They're all the credit cards are Visa. So right off the bat, I'm like, oh, okay. And then I go ahead and I do some further research, and Visa has the vast footprint there when it comes to credit cards. And so I like that. And then I can start getting into the weeds of the numbers. But I think that's the first approach. When you make your approach, it's like, do you actually use it? Do you own it? Or are you listening to noise and hearsay? Do you do that as well?
Yeah, I couldn't have said it any better than that. I take the same exact approach. And my thought process, in addition to all of that, is when it comes to, I'm in the same camp that you should just pick one. I don't think there's a need to own both Lowe's or Home Depot. The things that are going to benefit Home Depot are also going to benefit Lowe's. Chances are, if Home Depot is going through a tough time. Lowe's is going to as well. So the same things impact those two companies in the same way. So if that's the case, that it's, yeah, you're adding extra companies, but like you said, does it really add much diversification because you're pretty much just adding a duplicate of another thing? Yeah, no, I don't think so. So yeah, just pick which one you think is the better of the bunch. And when it comes to deciding what that is, just research it like you would any other company, and you can come to some sort of determination based on what you find. So, and
Let me
Visa was a
also,
great example. Like that was one of the things for me too with Visa. The network is much larger. All else, everything else is relatively similar, but Visa's network is much larger than MasterCard's. And so that network effect is much stronger. So you could make the case that they have more of a competitive advantage because of that. So that was one of the things that drew me to Visa over MasterCard as well. Sorry, what were you going to say?
I was also going to say, so many people it's a pet peeve of mine when people are like, I have like 80 holdings in my portfolio. And when you really and you do portfolio breakdowns, so I'm sure you've seen this a bunch and you probably said it a ton, but I think it's important when you are looking at your portfolio and should you be a investor with 60 to 80 holdings, start to look at what you can consolidate. And is it really worth having, I don't know, a position in Home Depot where you have maybe you're doing well with Home Depot and you got like 80 shares or 100 plus shares, which is great. And then you have Home Depot with like 25 shares. And I see a lot of that where I go, you'd actually really fire up that Home Depot position to put you in a far better position than just owning a little sliver of Lowe's because you want that. People call it diversification. I really don't think it's a great job of diversification, but go and I'd also love to know, there's people here with us. How much are all of you investing per month or per week? Because now when you go to actually invest and you're investing into Home Depot and Lowe's, but you only have X amount to invest, maybe it's $100. Maybe I find it hard to believe that a lot of people out there have, $2,000, $3,000, $4,000 every month to throw into the market. And if you do, all the more power to you. I just know that game well because that's what I do. And it really requires, hard work and a lot of sacrifice. And again, if you're doing that, amazing. And if you're not, then that's where I get really careful with what to invest into, because you could really build up and scale these positions that are behemoths of a position that will take you over the course of the longer term much farther in terms of an ROI than just getting slivers of every company across the board. And there we go. 300 to 400 euro, $1,000 a month. Nice. Brian coming in 2,000 monthly.
Nice.
That's great. That's great.
Yeah.
I would suspect, again, a lot of investors out there nickeling and diming just to get to a couple hundred. And if that's where you are, again, like concentration has been a total game changer for me. And there's a question up there. Let's see, by Divi Check. How do you guys proceed to decide which stocks to remove from your portfolio when you want to concentrate a little bit more? Ryan, I'll ask you that question first.
Yeah. I was going to say this a few moments ago, but when it comes to my portfolio, but also the portfolios that I review over on the channel, one of the first things that I look for is how to consolidate, because to your point, Ari, you see a lot of, if it's ETFs, you see a lot of ETF overlap. If it's individual companies, one thing that I notice is that you see a lot of positions that are small, positions that are, maybe 1.5% of a portfolio or less. It's not uncommon when I'm looking at these portfolios to see positions that are, 0.2%, 0.3%, 0.1% of the portfolio. And so when it comes to, figuring out which positions to get rid of, I think that's such an easy place to start. Look at the positions, look at the smallest positions in your portfolio. Not saying that because they're the smallest, they should go, because you're always going to have a smallest position, a couple small positions, whatever. But, if you have positions in your portfolio that are 1% or less, those probably are not going to move the needle for you very much. And this is how I approach it in my portfolio too as well. I'll give a concrete example in a moment, but I think that's one of the easiest places to start when it comes to consolidation. Look at the positions that are moving the needle less for you. Sometimes these are new positions that you just started and are building out, which is a different story. But oftentimes these are positions that you're just kind of sitting on and maybe don't have plans to add to again. And if that's the case, what's the point of even having them, especially if they're individual companies? You want to keep track of all of your individual companies, know what's going on with them. And the smaller the position is, the less worth it is to spend the time keeping up with them. If you've got, theoretically, you should spend the same amount of time on a 0.5% position and an 8.5% position when it comes to just keeping up with them. And I don't know. I just think if something is so trivial in your portfolio, what's the point of even having it? So I think that's one of the best places to start when it comes to deciding which stocks to remove. I'm going through that right now with AbbVie. I think it's a great company. I've done really well with it. But as my portfolio gets larger and larger, and that's the thing, as your portfolio grows, those small positions get even smaller. But now with AbbVie, I'm at a point where it's like 1.8% of my portfolio. I've done really well with it. And I'm hesitant to let it go because of that. And I'm still doing really well with it. But as time goes on, I am noticing it become a smaller and smaller percentage of the portfolio. So I think there will come a time where, even though I think it's a good company, it's one that I will let go of for all the reasons I just mentioned. It's moving the needle less and less in my portfolio as the rest of the positions grow. So, that's something that I do myself as well. But otherwise, when it comes to deciding which stocks to remove, in addition to that, I mean, maybe look around and be honest with yourself. If you can distinguish which positions are maybe not of, like, in a big way, not of the same quality as some of the other positions, then maybe that's an indicator as well. Because at the end of the day, you want to invest in high quality companies. So let's say hypothetically your portfolio, I'm going to throw out just a few stocks. Okay. We've got Visa in there. We've got Microsoft. Let's say we've got some Rollins. You're lucky if you've got some Rollins in there. Maybe you've got some Williams Sonoma, but then you've got Walgreens. Okay. If you're trying to do some consolidating, and I know this is a very exaggerated example, but if you're trying to do some consolidating, I think when you look around that portfolio, it's a pretty easy decision. So maybe take that approach as well and see what are some of your laggards, what are some of your bench players, I suppose. How can you remove some of the bench players and make more room for the starters? Maybe that's not the best analogy, but you know what I'm saying. I'll pass it over to you, Ari, because I've been rambling.
Yeah, I like that. Make room for your starters. I go make room for your superstars. Try to keep them on the court, keep them on the field as long as possible. And at the end of the day, I think every day should be a reset. And this gets so broad, but it of course that applies to investing. It applies to life. Everything that we're doing every single day, it's a new opportunity to pivot in different directions should you need to. And so when I was in the process of trimming down from 40 holdings now to less than 10, that was a daunting task over the course of a year. And I made goals for myself. Okay, I got to get rid of 2 to 3, holdings this week or this month. And it kept going like that up until I got to my goal. And so I think one of the most important things that you could do as an investor is evaluation on yourself. Evaluation on your goal. Your profile is so important as an investor. Understanding that investor profile and then investing accordingly. Because if you're an investor who, again, the young investor, but all of your holdings are AT&T, Visa, Altria, and I don't know, these crazy high yielding stocks, well, that's not terrible because you're still invested. And I'm not here to say you're just losing money, but you're leaving money on the table, in my opinion, based on your age and your ability to collect on the appreciation of some of these growth-oriented stocks, dividend growth-oriented stocks. And that's really important. And so I would first sit down and evaluate your investor profile. Then I'd look at your goal. And then I'd go back into the portfolio itself and say which of these holdings is getting me closer to that goal and which is getting me further away from that goal. So in Ryan's example with that portfolio, Walgreens is a very easy example. So let me crank it up a notch. Johnson & Johnson was a big one for me, and that was that move or decision to get rid of J&J took me a moment to really think about it, because I really, was struggling to answer the question, like, why is it in my portfolio? It's a great company, check. It's a dividend, just whale, check. But I looked at some of these other dividend growth stocks, and I looked at my goal, and I'm like, is J&J worth it to keep on the field right now? And I kept coming back to no, it's not. And I had a big position in J&J, over 100 shares. I think I had like 120, 130 shares of J&J. And I was seeing the dividend income from it, and it was great. But you know what? Since I've made all these decisions with these dividend growth-oriented stocks, I mean, Ryan, you've seen my portfolio, soar over the last year and a half. And I couldn't be happier with my decision to consolidate and to double down on high conviction stocks that are still of quality, but I'll call them, these are my superstars. And what I have, the stocks on the bench, if you will, they're not even in the portfolio. They're not even getting playing time. They're on my stock watch list, maybe, but they're not getting playing time.
Yeah. No, that makes sense, man. Why don't we jump into some of these questions from you guys in the chat? I've got, looks like 4 solid questions saved. We'll start with this one here from Janice, who says, here's a question for you guys. What is the difference between income investing and dividend investing? Right now I'm reading The Income Factory by Stephen Bavaria. Good book. I haven't read that one for a few years. Do you have a take on this, Ari, the difference between income investing and dividend investing? What do you think of that?
It's a great question. I would, when it comes to income investing, I think, first of all, I'm going to look at it because we have a new era worth of income. And I'm going to use the word distribution rates these days, which is now really interesting, because we have dividend stock opportunities, which is what we're all familiar with. And then we have, with all of these newer ETFs, distribution rates. And so you can really collect on both of these. But I think, when it comes to dividend investing, you are going for dividend stocks. And when it comes to income investing, it's purely income. And I want to say, when you're income investing, you are investing specifically for the actual income, versus dividend investing. You are investing, it's not, the income matters, but not as much. You don't necessarily need it. You're kind of like a Ryan. Like, Ryan's a dividend investor. I wouldn't call you an income investor right now until you probably are closer to that age of retirement and you're cranking the notch up on the income. What do you think about that?
It's tough. I think you explained it pretty well. I want to say that income investing is like a subset of dividend investing, but then again, that's also not true, because you made a great point. Income investing also includes distributions, which come from things like covered call ETFs, which maybe technically wouldn't fall under the category of dividend investing. It's similar, like in a sense, it can be kind of, not actually, no, I was going to say it can be kind of a different name for the same thing, but they are different, because distributions come typically from, it's either like a return of capital, or it's income generated from options premiums or other derivatives and stuff like that. And so that definitely falls in the income investing category. Whereas, like you said, dividend investing is you're buying companies that generate profits and free cash flow. They distribute some of that free cash flow to their shareholders in the form of dividends. And within that dividend investing umbrella, it can be like, there's a spectrum, right? You've got your dividend growth stocks. You've got your Johnson & Johnsons that are kind of like in the middle, decent yield, moderate growth. But then you've got the higher yielding dividend stocks like the Altrias or Main Street Capitals or REITs like Realty Income or whatever. And those can definitely go in the income category. So they kind of, you can kind of double dip between the two. There are some slight differences, but they're also, like I said, they're also kind of cousins, and they tend to play together in the same sandbox at times. But with all of that said, I wouldn't get too hung up on the labels. I wouldn't. Yeah, I just wouldn't get too hung up on the labels. At the end of the day, no matter what type of investing strategy you approach, between those two, let's just stick with those two. Whether you are looking to be an income investor or a dividend investor or a combination of the two, whatever, no matter which camp you want to fall into, the important thing is that you're investing in assets whose distributions or dividends will be stable or go up over time. I think that no matter which way you slice it, that is a non-negotiable. At least it is for me. And no matter, what label you want to use, I still don't know why anyone would want to invest in things or put money into things where your income over time will go down. And we see that a lot more with the income products. And I just don't know why you would want to put money into those things. You know what I'm saying? And I'm probably rambling at this point, but I guess that's where I
There's a
settle
lot
with
of
it all.
confusion around those products, and that's unfortunate. I don't know if it's a lack of people doing their due diligence, which that's I feel that's really where it comes down to, because every investor has a obligation to make smart decisions, therefore doing their own due diligence. You should never invest in anything just because someone said to invest in it, or just because you saw some cool advertisement. Those ads can get pretty sexy, but you really got to be careful. And especially with the newer income products that are, advertising their distribution rate and not their dividend yield. That's really important. But we're talking about erosion then there too. And what we have to keep in mind with a lot of these newer income producing products is the fact that they're actually meant to be daily reset, so to speak. So the objective resets itself daily, which means they're not long-term buy and hold vehicles. And that is incredibly important for people to understand, because and that's where the dividend investment community, I think, gets a lot of dividend investors find themselves in trouble, because this community is a buy and hold forever type of community. And then you have these newer income ETFs coming out that look really sexy. And it's like, wow, I'm just going to buy this and hold this, and erosion's occurring. And so if you're not careful with those products, yeah, you'll get that distribution, but you're losing money over the long term. And that's because the objectives are reset daily, which means you're resetting daily.
Let me ask you a serious question, because it's so crazy how many, to me, it's crazy how many occurrences I see every day across all social media platforms, whether it's YouTube or Blossom, even Instagram. The rare occasions that I jump on Twitter, I see it there too. It's just crazy to me how prevalent these a lot of these income products have become. The standard names, the yield maxes and the like, whatever, they're everywhere. It's undeniable. They are everywhere at this point. Do you think that, and once again, this is a serious question, I don't know the answer. I'd love to get your answer. And also you guys in the chat, I want to know what you think too. Do you think that people who put money, generally speaking, put money into these, buy them thinking that they can hold them long term? Or do you think that most people know this isn't something that you buy and hold forever? What do you think? Where do you think most people fall in that?
The vast majority of people have no idea what they're investing into. The vast majority of people who are investing in a lot of these funds, I'm not talking about us here in the deep end and in the chat and me and you, I'm talking like the vast majority on a granular level retail investors don't know what they're doing.
So someone who's buying into ULTY, MSTY, they are thinking, I'm a buy and hold long-term investor. This is what I'm going
They're
with.
thinking one thing and one thing only. I'm going to get that money. That's it. And they're doing that exact dance.
If you guys are tuning in on you guys are listening on Apple Podcast, you're missing out because this is one heck of a move.
That is the exact dance that they're doing. They're clicking buy. Robinhood shooting, confetti at them. Like the whole thing is going on, and it's dopamine. It's dopamine, and this is the problem. And I don't put it this way. I was just with my nephews this past weekend, and my brother has a fairly large dog, and my two nephews were sprinting around the house and playing tag with the dog, and the dog was playing, but the dog kept nipping at their arms, and then they would cry. They're 6 years old, the two of them, and so then they were crying. And for me, I'm a dog owner as well. I actually, I was helping a kid who had, was struggling in some capacities, and he's kept bringing his friends to the dog park. But this happened there too, where like the kids get excited and they're having fun, and then all of a sudden someone gets hurt, or the dog takes it's a game and the dog does a little nipping and whatever, the kid's crying now. And I say, do you know what you signed up for? You signed up to play with the dog, and this is what happens. If you're not careful and you don't know what you're getting yourself into, things are going to happen. And so very comparably here, it's just like you signed up for a distribution rate. You signed up for a product that is to be reset daily, not a buy and hold vehicle. And that's so important. And the retail investor is in this for the money, obviously, as we all are. The problem is when you're just in it for the money and you don't know what you're doing, you're bound to make mistakes. And that's even on the emotional level too. And for a lot of these people, it is an emotional decision. A 20% yield, I'm in. Yeah. And it's not like, do you understand what's going on the other side of that?
Yeah, totally. And I almost feel bad in a sense because I understand like the emotional part of it, because you're looking, you're investing with the goal of quitting your job, of being able to live off your passive income, of controlling your time. And I think a lot of people, not just when it comes to these funds, but I think every investor, myself included for sure, I look at this as a way to achieve that full ownership over my time. And so I think, people see these super high yields. They also hear stories now, a lot of stories now about how this person's making, $10,000 per month or $5,000 per month with just this super small investment. They're playing with house money now. And so they start to see the dollar signs and start to see themselves in the position of that person who, from what it looks like, has made it with these funds. And so I think that there's a really big allure to it because of that. Now they've been around long enough that people are, have whole channels dedicated to them. And that's not, I don't know that I have a real opinion about that, because I do think it is possible to make money with these funds, but not over, Ron asked, what's a long-term? What do you mean when you say long-term? I don't think a lot of people will make money with these, on a net basis after 5 to 10 years, probably close. I think the farther out you go, the less likely you are to make money on it, which is the opposite of how most investments work or should work when it comes to the stock market as a whole. Generally speaking, the longer you hold, the more you're likely to make money on that investment. But I think that plays into the emotion side too. People see these success stories now.
Well, that's exactly right. Defining the term long-term. And I think we are also getting very confused, especially nowadays, where long-term can mean 7 seconds. Like, for God's sakes,
that's true.
Like people, I think it's, because of social media. I think it's because of this 135 character only, YouTube went from long format now to shorts, and then TikTok and Reels, and everything's like man, how deep can you really go on a stock in 3 seconds on a shorts video? Because you got 2 other ones to pitch, or talk about. And this is the way we're functioning now. And so what used to be long-term and what still is classically defined as a long-term, position would be the 5 to 7 year window. Or if you want to go by the tax definition, after at least a year.
Mm-hmm.
But I think our definition even gets, reworked with some of these funds, because if you're thinking, oh, long term is like 2 months, I'm going to hold this for the long term, right? In quotations there. Well, that's still short term. And you got to watch what you're investing into. And if you're, again, those definitions aren't concrete for you, I just think you're not an investor. Probably you're a gambler. It's speculation at that point, what you're doing.
Yeah. Kind of a follow-up here from Janice says, I have to get farther into the income factory, but do you really equate Stephen Bavaria with yieldmax ETFs? First and foremost, have you read the Income Factory, Ari?
I have not.
It's been a handful of years since I've read it. It's worth checking out. It's kind of it's kind of a staple investing book, especially among, the dividend investors. So I'd recommend it. It's worth going through, but and like I said, it's been a number of years since I've read it, so I'm a little bit fuzzy, but I would say probably not. I don't know that I would necessarily equate the two here. Maybe a little bit, but from my recollection, Stephen Bavaria's one of his main arguments in the book is that total return is total return. Whether if you have a 10% total return, it doesn't really matter if 4% comes from share price, 6% comes from income, or vice versa. At the end of the day, it's still a total return is still a total return. And that's what leads him to go more the income route, that's kind of how he justifies going more towards income at the expense of share price appreciation. But in that argument, he still understands that no matter which way you slice it, you still want to see a positive total return. And so I'm kind of losing my train of thought. You still want to see a positive total return. And I like I said, I think over a long period of time, I just don't think you'll find that with a lot of these yield max funds. It starts with the NAV erosion, and then the options premiums decline from there. While at the same time, they try and keep the distribution stable by increasing the percentage of return of capital in the distribution versus options premium. And so like I said, I think over a long period of time, you'll see a negative total return. So it's a really good question. I'd be very curious to know what Bavaria thinks about those funds, but I think he probably would not go for them. I would imagine that the NAV erosion is just over time is just too much. It's too much even for him. And so I think where he probably draws the line is like the closed-end funds. And not all of those are good too, but I think he probably looks for ones, whether it's a closed-end fund or a covered call ETF or a BDC. He'll look for assets that aren't really going to erode over time because of the want for that positive total return, if that makes sense.
Yeah, there's a question that came in, or I don't know if it's a question, but a statement here from Tom S. Didn't Ari talk to someone who had success with these ETFs? And yes, I did. It is to say you can have a lot of success with these types of ETFs. But if you listen to the interviews in full, you'll actually hear these investors say that they watch them every day. They're tracking them every day. And so that is, a part of the equation for, and not just, I don't even just have one of those types of investors on. I've had multiple, investors on who are into these derivative-based ETFs and income-producing ETFs. They watch their portfolios like a hawk. And so if that's something that you want to do, then by all means, more power to you. You can make money from them, but they're designed for you to watch them. They're not designed for you to kick back and relax. That's really where you get more of the reliable dividend income producing ETFs or individual stocks that come into the picture over the course of the longer term. If you really just want to kick back and relax, that's where the dividend stocks come from.
Yeah. and I've thought about this quite a bit. Like, what do you do? Okay, you're watching them like a hawk because, and I guess you should with all of your investments, you can go a period of time without checking in on your dividend stocks. You can certainly like not pay attention to your ETFs. If it's like a VU or an SCHD or a VIG or, other ETFs, straightforward ETFs like that. But I wonder a couple things like, do you have to watch them like a hawk like that because you don't necessarily trust them? I'm sure, I can't help but think that's part of it. And if that's part of it, if I'm right, I could be wrong, but if I'm right, then I think I don't know why you'd want to own that to begin with, then, if you can't trust it, if you can't put your trust in it. But number two, like, okay, so you're watching it like a hawk and you're watching it to see when you should sell, if you need to sell. Okay, well then let's say hypothetically you need to sell. You have money in TSLY, you see it going downhill. Now what do you do? What do you replace that with? You just jump to the next fund that's maybe going to do the same thing, and then do you just keep repeating that process? That's the part that I don't quite get about it. What is the long-term strategy with this? Because the way I see it, it's if that's how it goes, you're jumping from one sinking ship, slowly sinking. It's got some holes in it. You're jumping from one sinking ship to the next one, to the next one, to the next one. And you're just doing that, I don't know, forever, or at least until you get tired of it. But then let's say you get tired of it. Well, then what do you do? Because you've based your entire retirement plan on this thing that's creating this amount of income today. And because the yield is so high, you can really only go downhill from there. It's like you can't go from that strategy to then just putting it all into SCHD. You can't even go from that type of strategy to then putting it all in something like JEPQ, which still has a double-digit yield. Like you're going to have to go back to work. So I don't know. I don't get it, is what I don't get it.
You always got to look at the underlying, right? So you got a lot of these 2x or 3x positions that are out there now, funds that are out there. And so that just means that whatever that underlying does at 2x or 3x will 2x or 3x the return. But the more volatile a stock is, again, now you're talking about, well, you're going to get income in there. You're playing options. So that's why you have to watch on a day-to-day basis, because these ETFs are resetting themselves, so to speak. You're not, what's happening on Monday through Friday is a lot of action. There's a lot of volatility. So if you take like a Tesla, for example, it's a very volatile stock. It's in the news often. Musk is either tweeting something or doing whatever he's doing that then drives the stock in one direction or the other. So that's where the options then come from. And if you're 2x or 3x, now you're talking about, you could be 3x on the negative downward spiral, right? And that's not where you want to be. And so your head just has to be on the swivel, not so much that it's a distrust for the actual holding in and of itself. It's just that the underlying stock could be incredibly, incredibly volatile, just like any other stock, right? Stocks sometimes get volatile. And even if you take a dividend stock, let's take AT&T, a few years back, it was just going down, going down, going down. And you had some investors saying, I'm going to buy more. It's going down. 18, 17, 16. I'm loading up. It's going down 14, 12, and it just keeps going. What are you doing? What's your strategy? And that's where I'll come back to, are you investing because it's paying income? That's a stupid reason. Excuse my directness, but that's a stupid reason to get invested into a position. You have to have a strategy. What is your strategy? What are you doing? And just wanting income is not a strategy. It's feeding your ego, so to speak, and that's what I had to address for my own self with J&J. It was like, why? Okay, it pays income. You're getting reliable dividends from it, but like it's not helping you get to where you want to go and the pace that you want to get there.
Yeah. Real quick, shout out Alfredo here with the $20 super chat. This is our first super chat here on the Deep End channel. Get both of yourselves a 10-piece McNugget combo. My friend, Thank you so much. It's funny. We've been seeing, I don't know if it's ads on social media or like on YouTube or whatever, but when my wife and I will be like in the kitchen cooking, we'll see it on our little Amazon screen there. And we'll see the ads for like this, the $6.99 20-piece McNugget. And every time we see it, it's like, man, should we go? Should we just go? $6, 20 McNuggets. Haven't done it yet, but it's very tempting.
Dude, I haven't had McDonald's in, I think, 15 years.
Oh yeah. Yeah. It's been a long, I had it once last year. We did a staycation at the Palms and just late night, had McDonald's, but
Margaritas came beforehand.
Yeah, absolutely. But then beside that, I think it'd been years as well. A long time.
Yeah.
But Alfredo, thank you again for the super chat. That is too kind. But real quick, going back to what we were talking about. Oh, sorry. What were you going to say?
No, I was just going to say thank you so much for the I'll just make nugget investment.
Yeah.
I'll have to find something else to eat.
Go get yourself some Ben and Jerry's.
Yeah, there we go.
But Ron said, going back to our conversation, but Ryan, sometimes you may be able to do that, like jumping from stock to stock, with some stocks or REITs as well. One could go from Orchid Island Capital to Annaly Capital, which are both bad. And I completely agree. One could do that. But as someone who has talked about both of those stocks numerous times as being big fat yield traps, I would say the same thing. You don't put any money into those to begin with. If you look at Orchid Island Capital's dividend history, every single year, actually, I think 9 out of 10 years over the last decade, they have reduced their dividend. The dividend per share has gone down 9 out of 10 times over the last decade. And so once again, I just don't know why you'd want to put money into something like that. So yeah, I don't know.
We're fooled often by the allure of what could be, that we pull ourselves out of reality. And call it marketing, call it advertising. That's what people spend millions and billions of dollars to get us all to do, to react to things. And I just think you need to be smart. You need to have your head on the swivel. You need to understand what's going on at a granular level. When you go, one of the easiest things to just look at, and past performance does not dictate future results. That's really important to understand. So you could have a stock that is going down for 2 or 3 years for whatever reason, and then all of a sudden maybe a new CEO steps in, that thing reverses and starts to soar. But at the end of the day, if you want a really quick measure, I feel what I always like to do is just, when I look at a stock, how's it performing on the year? That's great. It's up, or that's great. It's down. Maybe it's an opportunity, but let me click to the 5-year and 10-year. Let me see how it's doing over the long span of time, because very likely it will continue in that direction.
What do you think? What do you make of this comment right here from Denise? Good point. Not everyone is dumb. Some people just need money. What do you make of that? Because we're not necessarily saying people are dumb, are we?
Well, so actions. So let me put it this way. I don't judge people. I judge actions. And actions can certainly be ridiculous. But at the end of the day, I just working in the industry, seeing what I see on a daily basis, even just not working in the industry, being on YouTube, having the comments, having the DMs, having the emails. Sometimes I just got to ask, like, what are you doing? How are you investing? And I think when people are investing for income, that's fine. But a lot of the times, like 8 out of the 10 times, those people don't need the income right now. It's fear-based investing. Or there's a lack of due diligence going on. I don't think people are dumb. I just think they're not doing their homework.
Yeah. And everyone needs money. No one's debating that, but you don't just, if like Ari said, if you're someone who needs money today or like soon, if you need that income right now, there's still a right way to do it and a wrong way to do it. If you need money right now, but you haven't prepared, I don't think that gives you the green light to then try and take shortcuts with these high yield funds, because it's not just about money today, it's also about money tomorrow. And you need to make sure that the money that you have today will be larger tomorrow. You can't just think about what's going on today.
There are other ways. Brian, I've gotten this actually a lot. Now I'm getting fired up a little bit, but I've gotten this a lot, and I'm sure you've gotten it too, where people are now in the fear mindset and they start investing, and they're usually older investors who go, I need money now, right now, because I failed to get invested earlier. And the first thing I want to tell them is like, all right, first of all, relax, because any move that you make out of fear, or any move that you make out of, the irritability of your mistakes, if you will. I don't know if I want to call it that or not, but let's just go with mistakes. You're going to make a larger mistake. And so if you need cash flow right now, you got to keep in mind that your $100 or $50, wherever you're investing, whatever amount of money you have, you're probably not going to get that return that you're looking for in terms of cash flow right off the bat. So even if you invest in some of these companies or ETFs or whatever it is you're investing into, you're not going to see the cash flow you need. The people who need cash flow and need cash now, thinking of JG Wentworth, you ever see that commercial?
Oh yeah, 877 cash now.
So happy that's out there in Vegas. Anyways, the people who need that cash now, I don't think your best bet is the stock market. I think your best bet is getting your butt to work. And, with all due respect to everybody, I was just, this past weekend, I was at a funeral. It was my grandmother's funeral. She worked well into her 80s, not because she had to, because she wanted to. And so I don't really, people who freak out at 50, at 60, and they're like, oh my God, I need to get all my money into the market and try to make a quick buck right now, cash instantly. It's like, no, you need to still strategize. And I'm sorry, but you failed, and you need to get out there and go to work. And if you start to make certain moves out of fear, you will likely lose more money.
Yeah, it's a decision for the short term that will typically result in some sort of detriment to the long term, your future self.
So there's no magic, the stock market is not an ATM, magic money maker. It's not how it works. And so again, okay, you buy some dividend stocks and you maybe get that quarterly or monthly dividend income. You're not getting the amount to pay rent or groceries. Coming up next.
Ron said, for those of you guys listening to the podcast, I would laugh so hard if Ari's videos were sponsored by JG Wentworth. That'd be so funny. You'd have to do it in the opera. You'd have to do it in the opera voice.
Oh, man. Look, I just hate to see people panic and invest out of fear. I absolutely hate it. And I see it happening more and more. I see it happening when we're comparing ourselves to other investors. I don't really care. When I do Masters of the Market, I'm speaking to a wide variety of investors. I was just on, if anybody caught my last Masters chat, with an investor who's 31 years old, who's a millionaire from investing into, certain funds and playing options. I'm not sitting here jealous. That's his strategy, and I have mine. And he watches the market more than I do. And, though he is the millionaire, he's also living off a margin. I don't know if I want to live off a margin. So it's, again, you can't be jealous of someone else's position. You got to be in this game for yourself. You got to strategize, take out all the noise, and do what's best for you. Be smart.
Yeah. And maybe for you, that is the risky covered call funds, or the swap ETFs, or the 2X future funds, or you name it. Maybe that is for you. And, throughout this whole spiel, I really want to hone in on this, because maybe sometimes in these conversations, it sounds like we're coming off self-righteous or like we know better or whatever. But I really want to reiterate that my stance in looking at those other ways of investing is I just don't understand it. I don't understand it. Maybe that makes me the dumb one. That doesn't necessarily make one right, one wrong. But I just want to iterate that. I just don't understand. And maybe I'm missing something, but that's always and I think I can speak for Ari when I say this too. That's the lens that we look at this stuff at. I don't get it. Maybe we're missing something, but we're okay. We're okay with that too, I guess.
Look, I work directly in this exact space, these types of income producing ETFs and leverage ETFs and all of that. And I can just flat out tell you that the vast majority of people don't understand it. And I don't invest into it because it's not my investment style, though I work within these, the realm of these funds. And I think that's also important. A lot of people in this space don't invest into them, believe it or not. And that's also something to think about. And that's not just me saying that. You have people, again, I've interviewed them on Masters of the Market, whether it was hedge fund managers or CIOs and CEOs, and they have their companies and they're not invested in these funds. But they are invested in the S&P. They are invested in a very stable approach. And that's also okay. They're not trying to pull a fast one on you. They're just building products based on what people want. It's like any other sale. Oh, you want an income producing product. We can create that for you. And that's what Wall Street is doing. That is why people have to be careful. Okay, you want income? Okay, you want it at 20% yield? We can make that for you. And income's yield max at 50, 60, whatever percent yield. Okay, so you could do that. But then you got to ask yourself the question, as an investor, does this ultimately reach my investment, help me reach my investment goal? Or is this just me wanting income and wanting it now for reasons that are beyond the self because you really don't need it in that moment?
Yeah, Janice here says 90% of my portfolio is VOO/SCHD/VGT. So I'm good with the income coming from JEPQ. Nice. It's a solid balance.
It's a very solid balance. I think we're talking about people who are like, sometimes all in on some of these crazy yielders and just holding.
Yeah. Well, this is probably a good place to wrap it up. Before we do, give you guys one last shot. Drop any last minute questions for us before we head out. Man, is
there anyone out there that's dying to have a question answered? Like at the edge of your seat, you just need this question answered. And Ryan and I will take a stab at it before we call it a day here.
While we're waiting for that, it's always a can of worms when you start getting into as soon as someone mentions yield max, it's a can of worms. Oh, here we go. This is a good question. From SJ with that's a euro, right? €2 super chat. If you have $40,000 in your brokerage, how would you invest that? $1,000 in brokerage.
I would put it in two ETFs. I would break it down. I would SJ, I don't know how old you are, so I'm going to assume that you might be in your 20s, 30s, or 40s. And if you're closer to retirement, I wouldn't do this approach. But if you are, again, 20s, 30s, 40s, even in your 50s, I would just take two ETFs. I would go with the S&P 500, and I would throw a chunk in there. And honestly, I'm thinking, depending again how old you are, maybe 10K or an even split at 20K. And then the other half into a tech ETF.
Yeah.
Ryan, what would you do?
Yeah, more or less the same. I would swap out the tech. Naturally, I'd swap out the tech with a dividend fund, or I would add it as a third one. And I think that sort of trifecta would honestly give you the best of all worlds. You got a nice foundation. You've got something that will probably be a bit more, growth aggressive. You've got something that'll give you some dividends. So you really have the best of all worlds.
33. We got an answer 33. There. 33 years
okay.
old, wife's portfolio, inherited the 40K. Put that right into the S&P or a tech-oriented ETF. And the reason why I say a tech-oriented ETF is because if you think the future is tech, then in 1 year and 2 years out from now, we're going to be living in an entirely different, I think, tech environment. And so just think 5 years out and 10 years out.
So you don't think SJ should consider any like horse and buggy companies, Maybe no telegraph companies.
Not
Nothing
at
like
this
that.
rate.
No,
Not at
okay.
this rate. Maybe Clear Secure.
Clear Secure, which I actually I'm happy to announce is I'm back in the green on that one. So we're making some money
There
on
we
that
go.
finally. Last question here. Great question from Jake. We'll make this the last one of the day. What was y'all's monthly contributions when first starting your portfolios? What was yours, Ari? We've talked about this, but let's give it a go.
I think I was throwing in about 1,000. I was always striving for 1,000 or so when I first. Well, first of all, it's important to understand the first thing I did is I had a big chunk of cash I threw in, and that was in an index fund, total market, and so I think it was like 20 grand or something I threw in there, and I just let that sit for a year or two. Mistake. Should have kept adding to it. I definitely had the firepower. Once I actually started investing, though, every month at least 1,000, at least.
Mm-hmm. Nice.
What about you?
Yeah, I started pretty small. When I was first getting going with it, I'm sure it was maybe $25 a week. Soon after that, I probably ramped it up to 50, then 75, then $100. I wish I remembered this, but you guys will have to go over to my channel, go back to some of the first few videos. You'll have to let me know what were the contributions like then. I mean, I can look it up too, but I would guess that around that time it was 50 to 100 per week. And the general trend is I've been trying to increase that over time as I think you should. But yeah, generally speaking, started off small, built it from there. And I think that's the best way to go for any investor. The good thing is if you're just getting into this and not knowing where to start, just start small. You can always ramp it up from there as you get comfortable. I think that's the best way to go.
So I think with that, we'll wrap it up. Yeah.
Yeah, wrap it up. Really fun episode, guys. It's always fun hopping on here and doing live because this is the best opportunity, I think, for us to do to actually get to a lot of the questions. We try to in our normal episodes, but we get so lost in our conversation that we don't always get to it. So I think this is a really fun thing to do. I think we should try and do these once a month just so we can come hang out with everyone and answer these questions directly. But guys, great chat. Thank you all so much for tuning in. All 61 of you in the stream. That's awesome.
Wow. Yeah, I want to say thank you. I also want to say, guys, if you really want to keep up to speed with Ryan and I, I'm going to just close out with how I started up here by saying we are powered up by Blossom, which means that you can find Ryan and I's portfolio on Blossom, totally transparent, everything we're investing into. There's a link down there in the description, the pinned comment for you guys to find us on Blossom. We'd love to see you there. Continue to fire away questions at us. You guys hear those sirens, or is just you hear those, Ryan?
Yeah, it's a party out there.
Anyways, guys, absolute honor and privilege to be on with 61 of you guys. It's crazy. We're going to do this again once a month live. But in the meanwhile, we want your questions, comments. So comment down below. But really find us on Blossom because that's where a lot of the magic of our conversations stem from.
Yeah. All right. We'll see you guys in the next one.